For a little bit more on the path ahead, we're joined now by Tiffany Wilding. She's managing director and an economist at PIMCO. Tiffany, always great to see you. I guess I'll start with your big takeaway on the Bank of Canada's move, which now we can add the ECB to the list of central banks that are focusing on rate cuts now here in 2024.
Yeah, I mean, so the Bank of Canada was the first of the G7 central banks to cut interest rates. It was in line with our expectations. You know, when we look at the Canadian economy, there's clearly been pass-through of monetary policy, tighter monetary policy into the economy. If you account for the population growth that we've seen in Canada, look at per capita GDP or consumption, you know, we've called it a stealth recession, but you've seen a recession in Canada. The Bank of Canada obviously also understands this. You know, they think there's excess capacity in the economy now as a result, and that just makes them more confident around their inflation forecast, that you are going to see inflation in Canada, you know, settling back to you know, their 2% target. So as a result of all of that, it completely makes sense that Canada embarked on its cutting cycle. You know, now of course they're not going to be dropping interest rates as quickly as they raise them. You know, I guess barring a recession, but nevertheless, we do think they're going to continue. This is going to be effectively a sequence of cuts. You know, we think they can get 100 cuts done this year in the remaining of the year. You know, again, assuming their forecasts are, you know, the data is in line with that forecast.
100 cuts. So they went 25 yesterday. So would you see possibly, you know, doing those in 25 basis point increments? Maybe they do that three more times, call it, in 2024?
Yeah, exactly. So you get these 25 increment steps. You know, of course, they're going to be data dependent. You know, I think they kind of went out of their way also to say that yesterday. Their bias here is certainly to continue with a sequence of cuts. You know, in terms of the data that they're going to be looking at, you know, between now and the July meeting, for example, you know, it's the inflation, the labor market data. Canada has already seen a pretty notable increase in the unemployment rate. Labor markets have eased quite a bit, you know, and absent, you know, some surprise on inflation, you know, we think they will cut again in July, you know, and that's, you know, absent some, you know, potential increase in housing prices. You know, I think Tiff went out of his way yesterday to say, you know, we're not targeting house price inflation. We're targeting overall inflation. You know, and if you look at it, ex-shelter in Canada, you know, they're effectively back to their 2% goal.
Now, what about the I know you cover mainly the North American economy, but what are the wild cards, do you think, on this fight against inflation? We mentioned the ECB this morning is raising its inflation projections for the year. So all of a sudden the market has to think, OK, maybe there isn't as much of a certainty on the rate cut plan from here for the ECB. What are the inflation considerations you're going to be watching? I mentioned a couple of things that I think came up with the Bank of Canada governor yesterday. The weaker Canadian dollar. Do we import U.S. inflation? Does the announcement that the Bank of Canada has cut rates bring people back into the housing market? Does that possibly bring people off the sidelines? Does it push up home prices? I mean, what are the components of inflation you'll be watching to determine whether they can get to that 100 basis points of easing that you think could happen?
Yeah, no, that's a great question. You know, I think ultimately, you know, when you look around the world, you know, not just in Canada, really everywhere across the developed markets, but the United States has realized a period of below trend growth, stagnant growth, slightly recessionary, contractionary in some economies. You know, certainly Germany, you know, and some of the others, Sweden and Europe, have been outright recessionary. So as a result of that, you need a period, you know, monetary policy works through dampening demand. You need a period of below trend growth, you know, to bring the economy back in balance and to, you know, to put downward pressure on inflation. You know, we certainly saw that in the Canadian economy last year, as I mentioned. That has given, you know, Canadian policymakers, Tiff, more confidence that you're going to reach the inflation target. That's why they've started their cuts. You know, and I think the ECB is in a similar situation. You know, they also had very stagnant growth last year. that resulted in, more economic capacity that's being created in the European economy, and it's giving the ECB a bit more confidence. Now, I think for Europe, the big difference, though, relative to Canada, is obviously the European economy suffered a pretty large, terms of trade and supply shock, with the Russia invasion of Ukraine and the following sanctions, that the West put on. So Europe has had to find other sources of energy to fuel its economy. So when you have that kind of supply shock, it just means that you have to have growth that's even, you have to have demand that's even weaker. So I think it's certainly reasonable for Europe to have a bit of a last mile problem. And I think that was kind of the hat tip that the ECB, this is what the ECB is hinting that maybe there is a little bit more risk that inflation remains sticky. But I think we also have to remember that in Europe, if you're getting a bit of sticky inflation, it still likely means that European inflation, they raised their forecast to 2.2. It's between 2 and 2.5. That's kind of within this 2-point-something zone that we've been talking about for all DM central banks, where their central bankers are okay with starting to, to cut interest rates here.
Just a final question on what ultimately you think the U.S. Federal Reserve does this year, which we mentioned the stock market has obsessed over, and we're going to have to watch that as well here in Canada, because I think there is this view that if there is a growing divergence between, in the case of the Bank of Canada and the Fed, ultimately does that limit how far somebody like Tiff Macklem can go, even if the inflation trends are looking positive. What's your current forecast for what the Fed does this year?
Yeah, ultimately, we think the Fed will be delayed. We think when the SEP, their new projections comes out at the meeting in a couple of weeks, the June meeting, we think they are going to effectively push back cuts. I think there's a very reasonable chance, just given the fact that they're going to probably increase their inflation forecast, there's a very reasonable chance they push back cuts until December. They've said they need a bit more confidence, just given the inflation reacceleration in the first quarter. And so we think the kind of December timeframe makes sense to us here. Now in terms of the amount of divergence between the Fed and the Bank of Canada, we think we have some room here. And obviously Tiff yesterday also suggested that. I think there's room for maybe 100 basis points of divergence, maybe before they start to, to get concerned. But we do think the Fed will start cutting interest rates, by the end of this year. The one other thing that I would say just about the Fed, we have seen data more recently with the JOLTS data and what have you that just suggested that eventually inflation is trending back towards their target. It just is a little bit more delayed than they think. So this is a situation in the United States where the cutting cycle is just delayed. It's not canceled. So eventually we'll get there, and with it, the Bank of Canada will continue to cut rates as well.